All right. Hi, everyone. Welcome to the TimingResearch.com crowd forecast news. This is the episode that would have normally been on February 23rd, 2026, episode number 516. Um, uh, but we are recording this beforehand. And so my name is David Kosmeter. I'm the creator of TimingResearch.com, and I have Jim, the option professor, here to do a market outlook update for you. So I'm going to go ahead and turn it over to him.
Okay, thanks, David, and thanks everybody for being here. A quick background on myself. I'm Jim, the option professor, and I've been doing options for many, many decades. I've also done seminars on options throughout the country and through Canada. So I have a lot of experience in options, and I also have a lot of experience explaining options to you. That's what I'm going to be doing here today. I'm going to be giving you a nice review of the markets because there's a lot of exciting stuff we're going to talk about. This is Friday before the Nvidia earnings of next week. So we've got a lot to talk about. I'm going to be sharing my views, sharing my opinions, and then, of course, if you have any questions on anything, you'll have a way of contacting me at the end. But I will be not giving any advice out. I just give opinions and views. Okay. So without further ado, let's start looking at what's going on here. Today was a big day. Let's start out with the big news. The Supreme Court has knocked down the use of the International Emergency Economic Powers Act, also known as IEEP, that the Trump administration used to throw all those tariffs on everybody. And basically, what they said is that their interpretation of the law was in error and violated the major questions doctrine, which the major questions doctrine says that it requires executive branch actions that have vast economic and political significance to be clearly authorized by Congress. Now, this is not a new thing. This was done in the lower courts. All the Supreme Court did was upheld the lower court ruling. But what they're basically saying here, as I can see it, is that you need to have clear congressional authorization to justify the extraordinary assertion of the powers to impose tariffs. And according to John Roberts of the Supreme Court, the Trump administration does not have it. So this is a big ruling. This is a big deal, and it is unknown how much upheaval there'll be. But a couple of things we know is that the plans to bring in trillions and trillions of dollars of tariff money might be delayed or denied. And the 175 billion that was collected through December 14th, some of that is at risk to having to be refunded. So again, these guys push the boundaries of these laws, and the boundaries push back a bit. So it'll be interesting to see the alternatives that they're going to try to come up with. While it might be nice to hear about them, they are going to possibly take a pretty good amount of time for them to get into effect, and they're probably not going to come back to give them as much power, as much scope as they had, or that they thought they had when they went off on this tangent of tariffs. So it is a big thing. Costco, for one, has already had refund requests in. According to Besant, they're going to take time in order to refund that, maybe weeks and maybe as much as a year. The other risk, though, is if this thing is all shot down and if this has to go through Congress, and I don't think it'll get through Congress the way people talk, the construction that's going on with all of these manufacturing things that are going on, that may be put on hold because, again, if the tariff risk is not there, maybe the going through the drill of making construction of factories may also get halted. So it's kind of a big deal here. And the markets, again, had a nice run up afterwards on the S&P, as you can see, but it has hit in some resistance. So let me just show you what the markets have done off of this news. I'm going to go to the 1 year graph, and you can see there's trouble getting through my moving averages here, which come in at around 69.11 and 69.05. And it went up into that region today. I'll see if there's any other averages that it kind of hit. Yeah, you see on the weekly graph, it went right up to where those averages were. That comes in on the red line, coming in at around 6,900. Went through it, and now it's back down under it. On the 1 month graph, again, started to turn up here. but it has run into some resistance right in this, I will call it the 6900 to 6950 range. That is a ballpark range of which, if the S&P can get through it, that would be very bullish. So you can see if we can get through and start closing above 6,900, that would be very, very positive. And then, of course, on the 20-year here, it's already extended. On the 1 year again, need to get above these lines here, and you need to get above them, and that's 6,900, 6,911. So 6,900, 6,950. We get above that. Then this concept that we're going to rally and this concept of we're going to go up towards 7,200 would make a lot of sense. Okay, looking at a couple of other indicators that I look at. One is the VIX. Very good sign that it's under 20, but it's not very far under 20, is it? And again, a lot of the moving averages are under the price. So we really need this VIX to get under 17 to take a really clear breather. If it gets back above 20, look at all those moving averages. They're all under the market and rising. If the VIX is going to 25 or 30, we're going to break those lows and we're going to come down. So very key neighborhood. And let me show you the key neighborhoods I saw on the well, I'll show you one other indicator that I look at. That is the market breadth. The market breadth was doing very good and is still doing pretty good. So here's my deal here, right? If the market breadth breaks under 58, let's call it, okay, it could go all the way down here and fill this gap and come down to 50. If that occurs, I think we're going to have a significant correction. And I don't think we're going to 7,200 anytime soon. If we do hold these levels and we get the percentage of stocks above their 200-day moving average to break back above 62, then I think it could come up and fill that gap at 66, maybe go up to 70, and then we're talking above 7,000, and then we're in good shape. So it's a very critical zone here, and I got some very key points that I think I can live with. And again, one of that is that VIX getting under 17, very big signal that the bulls are winning. The percentage of stocks above the 200-day average, get it above that 62 number. That would show that the market breadth is improving, which, as you can see, after April, when the market breadth was improving, is when you made all the money, right? Since the market breadth has been meandering, and it was very much tested here in November. Look at that. If it would have broken November, it could have gone into the abyss and filled some of these gaps down here, for all you know. So the bottom line is that you really want that percentage of stocks above the 200-day average to continue to matriculate higher. That means the breadth is expanding, and that's a good bullish sign. So again, very exciting because we got Nvidia earnings next week, and in a moment, I'll get into what I think that's going to do. But I just gave you, I think, a very accurate way of looking at it. Now, well, I'll get into that in just a second. The second thing I wanted to talk about before we move on was the economic numbers that came out on inflation. Even the gentleman that they brought in from the Trump administration to join the Fed is even concerned about this a little bit. So here's the deal. PCE came in year over year core at 3%, up 0.4% for the month. Spending up 0.4% for the month, and that beat estimates. So the spending is still there. That's good for stocks. And then, of course, the inflation numbers, again, are elevated. So there's no doubt that this report showed spending strong. It showed that the year-over-year core rate is still quite high. What has that done to the bond market? Let's take a look there. People are looking for 3 cuts this year, 3 cuts. Well, again, I've been using the 20-year graph, the monthly, because it smooths out a lot of nonsense. So as you can see, rates started to rise back in 2022. Well, they've actually started in 2020, so they actually accelerated in 2022 when the inflation rate jumped to 9% because of the temporary supply shortages, right? So here goes interest rates up, 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 and up. Then they cut 50 basis points in 2024 September, and everybody thought yields were going to tank. Well, they went down to the blue line, and then they went right back up again. Now, right now, they think the rates are going to be cut 3 times. If they are, you're going to go down to 3% on the 10-year, and it's going to be great to be long the bond market. Absolutely. Absolutely. It would be the big trade of the year, right? But it doesn't look like it's having an easy time breaking again. And look at all those averages coming in. So I think one of two things is really going to happen. There's going to be a surprise in the stock market when yields pop towards 4.5 or 5, or you're going to have a resounding drop in the yield, and it's going to make the mortgage rates extremely low, maybe into the fours. And you're going to see obviously a bond market that goes way up, which is a nice asset boost to people. And then the interest rate sensitive stocks, like your housing, right? If we went down and mortgage rates really dropped, I mean, I think a company like this, where we need housing, right? We need housing, and these guys are the largest producer of cheap houses, would probably do pretty darn well. And that trend looked pretty darn good. So if I was going to say we're going to get that 3% and big drop in mortgage rates, this would be a stock that could benefit quite a bit. So keep an eye on something like that. If that happens, right now, as we see, it's on a ledge. And I've got people I know who loaded up on bonds and thought we were going to have a big break, and they may be right. But the surprise would be that it is not able to come down because of inflation and a strong spending situation, and inflation numbers don't back off. And then bingo, it surprises people. Now the positioning is not for 5% yield. So the positioning would be very frantic if we went up there, because all these people that are long that are looking for rates to drop would have to reverse their positions. And that, my friends, would be a very dramatic thing. So keep an eye on it. If we go down here, it's going to be great for mortgages. It's going to be great for interest rate sensitives, right? If we go up here, all bets are off on that one. And of course, the stock market may have valuation issues because of the fact that the higher interest rate has to be factored in. That's exciting stuff. So keep an eye on it, right? Okay, and GDP came in at only 1.4%. And, Trump was considering 15% GDP growth. That would have to have much lower yields. That's why he doesn't like Powell. And it would have to also require a substantial change, I think, in the trade deficit, which was shrinking dramatically back in October, but that shrinkage is stopping. So that would have to resume. So we'll have to see if things happen in those two fronts. But to get that kind of growth rate, you're going to have a little help. Okay, before I get into the Nvidia stuff that I wanted to talk to you about, I did want to talk about the Goldman Sachs Commodity Index, which I've been bringing to a subscriber's attention now for 6 months. Now, here's what it looks like as far as the index is concerned. And this is why it's been very helpful to me. Okay, can you see that this thing, and this is the last 5 years, it used to be up at 860, and it came all the way down here. And I viewed this as consolidation and the fact that it might break to the upside, which is exactly what happened. So if this is going to break to the upside, the Goldman Sachs Commodity Index, the thing you'd like to know is, what is it made out of? And I'll tell you what it's made out of. 50% of it is energy, and the other 50% is divided between metals and agricultural products. Well, having known that 6 months ago, right, and having that opinion, obviously things in energy would be something that you would think would have a big rally, right? Well, that's why on the alert, we have brought companies like this on the alert. And this is Chevron. So obviously it's been a very good place to be, but it is extended now. There's no doubt about it. It's extended. So it may have a reversion to the mean a little bit. Like what? Like if it breaks here, it could come down into this neighborhood. The little gap here at 170, maybe it'll come down to 170, and that might be the better place to join. Okay. Now, I didn't show you one thing. I'm going to go back real fast so you understand. This is, again, my opinion. This is what my thoughts are. My thoughts are this thing here has a gap right here in the 700 neighborhood, right? 702, right in that neighborhood. So if we're going to go, and this thing's going to pop up to 700 sometime this year, then energy, metals, and agriculture have a good future ahead of them. And so that's why any kind of dip in energy, as long as this thing is matriculating up, I think would be a buying opportunity. So that's why I'm mentioning to you that while this is extended, It is in a very nice breakout here. But again, it wouldn't shock me if it came down and filled something like this at the gap, and then basically the blue hits there. Maybe an Iran settlement might do it. I don't know. Anyway, same thing with Exxon. These are the two lead horses in energy. And as you can see, a great place to be all year long. And what gave me the clue on that? The Goldman Sachs Commodity Index, which is 50% energy. And obviously, the side companies that are involved, like the oil servicers, that's been a great place to be too. Okay, so this is something that has happened, but it happened with a little bit of advance warning because why? Because you had the commodity index indicating a breakout, and half of it is this energy stuff. Okay, so that's a good explanation. Now, the other thing is metals, right? Now, again, next week, there's a couple of stocks that have earnings coming out in the energy sector. So I thought I'd mention that to you quickly. And what companies? One of them is called Viper Energy. And if you look at the 5-year graph here, there could be some more activity on the upside. They have an affiliation, I believe, or business going on with Fang, which is Diamondback. And that's another one that hasn't really extended so far yet. So there could be an opportunities there because they're lagging. And both of these companies, VNOM and Fang, have got earnings coming out next week. Okay, so you got the energy sector of that Goldman Sachs index. What's next? What's next is the metals area. And you know, and I know, metals have just gone nuts. And again, oh, hang on here a second. I don't know what happened here. We'll try it again. Again, we got the idea that it would break out a month or two or three ago. So this is not surprising stuff, because this stuff has been going up since the fourth quarter on a parabolic move. But you see, when it has reversions to the mean, if you want to buy, that's where you get on the boat. Reversions to the mean. So you had an opportunity there, filled the gap. Maybe oil's going to do the same thing like on Chevron down at 170, and that could be a great place to take a bite. But here you had a chance to take a bite, and it's come up again. Now it is lagging on RSI, so this thing may not follow through. The RSI seems to be lagging down here, doesn't it? Yes, it does. So be careful on this one. Again, this is a great place to get on board if you want to take a chance because it could accelerate to the upside if this momentum turns up. But it has a double high area here at 60. And you know what? 60 and 55 on the RSI, in my opinion, is an area of concern. Because if we can't get into 65 and 70 on RSI, you're not going to get a acceleration to the upside, which means you're looking at a high point. So this is a very important area for the gold miners. If it cannot break through this neighborhood and get that RSI going, because right now you have a divergence. The first move up is 60, which again is a sign of a high point. Then you've got this double move here and 55. So breaking above here and getting that RSI above the 60, 65 area, that's how you could go out there and blow out the highs. Okay, so be careful here because all it's really done is fill this gap here. So if we do get under this number here, although it is rising, which means it is a bull market still, but it would open the door to maybe a quick reversal down here. So there's your support zone, 95 to 100 area. You want it to stay above there. And if so, then the future could very well be more of the same on the upside. You guys that are in the silver, again, you had your move. Again, we were thinking it was going to make a move because it's part of the metals complex, right? Part of the metals complex, which is a part of the second half of the Goldman Sachs Commodity Index. So this is not a surprise that it ran up. But people go, why did it come down? Because it's reverted to the mean. And what would you want to buy something against the mean? So right now, as long as it stays above 95 and 90, you'll be okay. But again, similar to gold, you have your RSI on this pop move that filled the gap to about 57. And over here, you're at 55. That's a neighborhood. If it can't get through, and for whatever reason, if it breaks 97, 95, it's going to open the door to a significant drop, maybe towards 80. So while it does look like it's had its reversion and it's back on the bicycle, you still have to monitor it very closely. But that's the story on the gold and silver. I know many of you have been in there. And again, that's why I like to use the short-term charts on things because the 1 month graph gave you a nice sell signal up here at 116. So you would have, been able to grab some profits. And then when you got the repurchase area off the 1 year graph down here in the 95 area, you could have also come back in. And of course, some of the copper stocks have done very good because copper had a big move. So again, metals, right? Metals, energy, right? The other thing that was very good on the alerts was Alcoa. And that was something we took advantage of on the alerts because obviously in December it's turning up. We already knew gold and silver turned up. We knew copper turned up. So the likelihood this might be turning up is quite high. And then it accelerated to the upside because it had a lot of room to go. You see, it was down here at 40, and you can see historically it used to be quite a bit higher. So all it did was accelerate to the upside, and right now it's reverted to the mean at 55 and now it's at 59. So that's your metals. That's your metals. And that's your commodity index. Remember agriculture was the other part of it. And, people who know agriculture know John Deere is involved in it. And so if you thought this was a good formation, which I would have thought it was a very good formation, and obviously when their earnings came out, that's what happens when you're in a bull market and the winds of change are blowing your way. That's a heck of a move, 500 to 650 in what, a month? And again, that's all part of the commodity index turning up, and that agriculture is a part of that index. Okay. All right. So that's all I had to say on that. And I think you get the idea of what's going on there and why. Why, right? All right. Now I want to get into kind of the meat and potatoes of some of the things I wanted to do here and get this thing off. And well, let me just hit a couple of other things real quick. QQQ. So you get the idea on what's happening here. QQQ must get above this number here, which is around 610 and then 616. Today's high, 617. Oh, what was today's high? Let's find that out. No, today's high went right into the 610 area, right? The high was 610. There's a reason why it stopped there, right? Because we got resistance right there. So that's why this thing still has a risk of going down. If we break 590, it will be going down. So the bottom line is that you still have to be careful. But what we're thinking could happen is that if Nvidia's earnings on next Wednesday are outstanding and their guidance is outstanding, it could be the match that lights the fuse. And there are many people who are now talking exactly like that. So it's possible because the positioning has definitely turned more negative because the VIX has gone above 20, but it's not above 20 right now. So like I say, if you can combine a break above 610 and 616 with a VIX breaking under 17, with the percentage of stocks above their 200-day average, getting above 62, 65, the idea that we're going to 7,000 or 7,200 on the S&P would have a lot more credence, a lot more credence. But it could be bumpy until we get those earnings. And so we got 2 more trading days before that happens. So we'll have to see what happens. But I just wanted to show you on the QQQ, the risk to the downside is still there. It's just done a decent job of following into support. Okay. And on the small caps, again, you got to hold this neighborhood up here around 260. If not, and it starts breaking down, you could go down to 250. Again, holding, we said 250, 255. There's your number, 250, 258. You see all the numbers that are coming in here, 250, 258. So there's your neighborhood and those highs here, right? Those highs here. That's your neighborhood where we don't want it underneath. Worst case scenario, you don't want it underneath 240, that's for sure. So the bottom line is it in a bull market? Yes. Could it have a pullback? If it does those things I mentioned, it will. If it does not, I'm sure this will get dragged up. And if interest rates ever drop, if the yields on the 10-year ever drop towards 3%, then this thing would have the year of years. And if you look back over a 20-year period, well, can't really see that. But anyway, it has a good future. Again, most of these stocks in this index are not making money though. So it is a risky index from that standpoint. So keep an eye on that. The other thing about the QQQ you want to remember is that the PE ratios have compressed dramatically. Valuations have compressed dramatically. In fact, for the first time in a very long time, the PE ratio on staples is higher than it is on software, which is an amazing thing. Walmart is a good example. And I was mentioning this to people. Walmart had a very big run to 135. The PE ratio was approaching 50 to 1. The revenue growth on Walmart, I think, is in the 4 to 5% range. That hardly warrants 50 to 1 PE ratio. So that's why we've gone from 135 down to 120, even though they announced pretty good numbers. Because again, that valuation is very, very high. Like I say, if you want to know where money may come from, if they get out of things and you wanted it to rotate back. See, it rotated all over out of software into what? Into the staples. So if it's going to rotate out of something, this is where the money is. This is let's call this is where the piggy bank is. Okay. And if they come out of the piggy bank here and rotate into the other, then that would be something. So again, um, what I'd like to talk about now is the Nvidia story. Nvidia is expecting their earnings on Wednesday of next week. So it's going to be a big week. And again, we'll also be digesting this Supreme Court decision and see exactly how people feel about that. You know, it just happened today on Friday. So at any rate, if Nvidia can hold these neighborhoods, which is obviously 170 and 180, and then if you go over here, you really want it to stay above this 185 area. But you can see if it broke under 180 and 170, it could have a very significant drop. Now, again, the RSI is going to make a decision because it's right there at 53. So if it goes to 60, 65, then we're going to be up in this neighborhood up here, which is very possible. If they come out with earnings that are just ridiculous and their guidance is ridiculous, and if Taiwan Semi's sales are going up at almost 40% and they make chips for Nvidia, common sense might tell you that these guys must have a tremendous amount of business coming in because they need those chips made, right? So, and a surprise on the upside, may very well happen. And so basically, for those people who wanted to gamble on something like this, if you look at the option prices here, I'm just going to show you something that on March the 6th, which is 2 Fridays away, we would look at something like the 200 call, and you'd see it's going for last trade 297. Let's call it $3. So $3, if in fact you could go up to the maximum risk when you buy a call is the premium. And so the premium is $3, gives you the right to buy at 200 until 2 weeks from today, March the 6th. So if this thing were to pop to 210, obviously the intrinsic value of the 200 call would be $10. So $3 to $10, nothing to be ashamed of. If it got a huge move and a spike, then of course, if it went up towards 220, that would be a real rainmaker because the option for $2.97 would have intrinsic value of 20 if it had that kind of spike. So that, for those who think, speculating on that occurring, that would be something that obviously you could lose the entire amount of 297 on that example. You could also be involved in a pretty good market move if these guys surprise and then the people come, because this is big sideways action. I mean, since December, this thing's been in a very tight range. So when a tight range, and look at all the moving averages converge. I mean, something is probably going to happen of size off of this. And if it does, you know, it could be a significant up move if it's a big surprise. Conversely, like I say, you have to admit, if we're going to go down, you're going to be looking at a big down move. Just to be fair and show you both sides of the trade, what if you wanted to think about a down move going in the next 2 weeks? What kind of risk is there in the premium? So say you're at the 180 mark, that's $430. And so that's $430 would be the total price of the option. Last trade, the ask right now is at 4. So say you got it at $4, $400 is your total risk. And if we go back to the chart and say the news didn't come out so well, you're looking at maybe going down to this gold line here. And if you went to the gold line at 160, the intrinsic value of the 180 put would be $20. So risking $400 to see if it might go to 20 on a big move. If it only went to 170, then it would be what? It would be giving you $10 on the $4. Of course, it has to happen before March the 6th. If it happens after March the 6th and it's above 180, you're going to have a 100% loss of the $400 if you didn't trade it out before then. So anyway, that's a couple of things on Nvidia that are interesting right now. But again, if Nvidia is going to take off, then will it possibly help the software sector? Now, again, this seminar is supposed to be talking about software stocks as well. And I'm also going to go over other sectors that could benefit. I already told you that if the interest rates get better, you could get some good housing situation. But we all know that the software stocks have been clobbered. All you have to do is put up this graph I'm going to show you right now, and you'll know it. And of course, if you're in tech, those high beta techs, you know that a lot of them did get hit. So that's called a big drop, right? That's called a big tank job. And that's in the last 90 days, right? So that's a pretty big drop. So what is the story on these companies? They've been, hit because of Anthropic threats, where Anthropic is going to replace coding companies and companies that, well, just a lot of different, shall we say, replacements or disruptions. So that's one thing. The other thing is valuations. These things had very high valuations, the software stocks, right? And so that's been offset. And then, of course, positionings. I mean, come on, look at the 5-year graph on software. Let's take a look. I mean, come on. It's gone from in 2023, it was at $45 and it went to 120. Well, that's a pretty big move. And it's had corrections before, but look where it's sitting right now. Look where it was sitting here. So again, this is the point that it's going to have to make a stand, or where else would it drop to? Let's go to the 20-year graph if that helps. It could go all the way down to 60 if it wants to. So again, this is the time this is the reason why the seminar has to do with Nvidia's earnings and the software stocks and also the Mag 7. Mag 7 and software. That's what this is all about right now. Okay. So let's get into it. Why would these stocks possibly stop going down? Technically, you can see why. And then basically, why fundamentally? Well, these companies, are companies that they help people leverage their AI integration to boost the efficiency of the money they're spending, which if they boost the efficiency on the money they're spending, could also be a key to the ROI that they need to show with the big AI spend. So again, among other things that the companies I'm going to mention provide, their platforms. They create cloud software, e-commerce, enterprise cloud solutions, cloud monitoring and analytics, data analytics and AI, specialized SaaS, again, which is software as a service for people who don't know what SaaS means, for the life sciences industry and the developer of tools and software. The cloud systems, they're going to become more complex, and these kind of companies catch problems and help manage data and workflows. So it's not like they don't have any purpose. It's just their purpose has been questioned through Anthropic. Their valuations were ahead of themselves. Some of these people are spending a lot of their free cash flow, which makes their balance sheet not as attractive to people. And then, of course, positioning, as we just mentioned. Okay. So again, what would make them turn around is obviously their value has been discounted too far. And when they announce their earnings, if they announce earnings that are showing good revenue growth, that could be something that would make people a little bit happier with them. So what are the companies that are coming out with that are in this genre? Salesforce is one. Okay. Now, Salesforce has earnings coming out next week. So they'll have an opportunity next week to say if their revenues are bad or if their margins have been shrunk or whatever. So this is one right off the bat, and it also has earnings coming out. If you look at the 1-year graph on it here, You can see also that it's trying to stabilize. The RSI was at as low as 20 here. Now we've made new lows and the RSI is at 29.30. To me, that's a divergence, and it's possible it might want to make a run and try to fill some of these gaps if the news changes. Next up on this is Microsoft. Microsoft, again, is down in this area. The RSI down here is around 29. Over here, the RSI is 31. Not a big divergence. We'll have to see. Does have a gap to fill if it can get off the ground. On a 5-year basis, it broke through purple. It's in the middle here, so it still could come down to 360. Okay? But it also could rebound rally towards 440, and that also would fill in this gap a little bit, which is clearly in the 440 to 480 area. And on the 20-year graph on it, it's right there in the neighborhood where it might stop. Okay, so that's the story on Microsoft. Let's turn over to Palantir, our old buddy Palantir. Now that had a valuation of 80 times sales. That is like ridiculous, off the charts. So that's why it had to compress a little bit. And that's what it's done. It's now hasn't, it doesn't have a 20-year history to it on this, but it does have a 1-year history. And we can see here that you've got the lows here with 25 on RSI, and now the RSI is 37. So that divergence is indicating to me the potential that the selling has dried up a little bit. Now, again, it's in a very, very much of a downtrend here. So this is a tough one to be, too bullish on, because where everyone made their money is when the chart looks like this, right? That's where they made the money. I've been in this thing for a long time. So, this is a stock that I've owned a long time. So it's been very good. But again, it has not been good lately, and it has rolled over. The 5-year graph also has rolled over, but it shows potential for a rebound rally. This one you got to be careful on because, again, the government is a big spender here, and if they change their tune on it, but again, valuation is the big key here. This company is doing very well. Their valuation, people just didn't want to pay that much for it anymore. Next one is Adobe. Let's how it looks this one, how this one looks. Okay, so you're down here on the 5-year. Obviously, that's very sold out. I mean, 650 down to 250 is pretty sold out. How's it look on the 20-year? Again, it still could come down towards 200. Okay, it still has room to go. But let's look at the 1-year to see if there could be a bounce ahead of us. And again, on this one here, you had a 29 on the RSI. Over here, you had 23. So you had 23 on the RSI, then you made new lows, but the RSI did not. And now the RSI is at 28. So if it got some reasonable news, it could have some value down here. Obviously, again, it is heavily discounted from where it was. Let's talk to the next one, which would be Shopify. I mean, you can't be surprised these stocks are way down. I showed you the IGV, which is the software index. And so as you can see, this is another one. If you look at the 5-year graph, it's down and hit some support. So this one, there's a reason why it bounced. And this is, again, if you're going to try to take advantage of anything that's correcting, you want to have some mechanism to figure out where it might stop. My purple line here has been very good there, has been very good there, and it just was very good here when in February it went down to what? The low was 104 and the average came in at 103 almost. That's pretty close to right on the number, right? So again, that's why that one's bouncing, and that one obviously is already started its bounce. So after Shopify, we got Datadog. And dog is a good word for it, right? Because that's what Datadog looks like. It used to be 210 and it went all the way down here to 110, half price. Okay. But these guys supposedly have still good revenues coming in, and they do serve a very legitimate purpose. So the bottom line is that, getting back above this number was very key in my world. And so that's 117. So the longer it's above 117, the better. Now let's talk about the 1-year graph. And again, it came back and filled the gap here pretty good. So again, where was the RSI here? It was at 23. Where's the RSI here? 34. That's a divergence, and that's why the rally occurs. Now we're back down to 45. So if it can hold 40, that's a good number to hold. And then, of course, is there room for it to go? There could be. So keep an eye on Datadog because, again, that's been sold off dramatically as well. The other one is VEEV. And that is another one that used to be almost $320 that went down to 170. So that's a pretty good discount. It's got a huge gap up here, right? So what does it look like on the 5-year graph? Okay, again, way down to where these are the lowest prices it's been since 2023. So it's pretty sold out down here. Now again, you had RSI 34 here, and now you got RSI 30 here. So let's see what it looks like on the 1-year. RSI here hit 21, made a new low, RSI 23, not much of a divergence. Up here, we're back to 32 though. So again, there is a potential for a bounce in the software sector, and maybe Nvidia blowing out their earnings would be something that would be a catalyst to see that happen. Then let's look at the last one I have for you is Team. And that is a stock that used to be, let's go to the 5-year. Yeah, it used to be as high as 340 and now it's down to 77 bucks. Okay, and it's down another $3 today. So it is very, very sold out. Is there any evidence that it could be stopping? There's not a whole lot. The only thing would be is that the low on RSI here was about 19, right? And we've made all of this low, a $40 move down, and the RSI is still right around the same. So again, whether this can take a rally to fill in that gap or that gap is unknown, but this is something to monitor at this point because they are extremely discounted. And you know how people change their tune. They didn't like oil stocks when Chevron was 140. Now they can't get enough of it as it approaches 200, right? They could not believe anyone in AI would ever lose money, and now you've seen some of the ones are losing or they're losing their value in stock. Boom. So things happen. And so again, this is a good time to keep an eye on the software sector because the bargains are there. You just have to figure out when they're turning. And again, some of you on short-term trading might be looking at the 1-month graph, which is a 2-hour graph or even the 30-minute graph if you really look at it very closely. And again, there's no evidence on this guy that there's any turn at all. But these are the charts that turn first, the 30-minute graph and the 2-hour graph. And again, so you keep an eye on these two if you're thinking there's a short-term turn, because that'll give you your first signals. So keep an eye on that. So whatever ones you're using, you guys have your own charts. This is a 30-minute chart. This is a 2-hour, 120-minute chart. They're going to be the first ones to make a turn if there is a turn to be had on any of this stuff. Okay, so that was the first part that I wanted to cover here. And the second part I want to cover is the Mag 7. Okay, so let's look at those guys. Amazon. Okay, look at the 20-year graph. You can see it's still in an uptrend. You see in the 5-year graph, this is the place where it would stop. You got it? That's why I'm having this meeting here. That's why I'm calling it, let's keep an eye on Nvidia's earnings, because if the tunes start changing, this is probably going to be a beneficiary. And the public is going to have about $100 billion coming to them, it's estimated, in tax refunds. They're probably going to spend it. And when they go to spend it, they may spend a lot of it on Amazon because it's the #1 retailer, isn't it? Something like that. Anyway, so there's your technical reason. And again, the fundamental reason might be they could have a big boost of business coming from the tax refunds. So there you go there. And again, has there been a little bit of a turn? A little bit of a turn. There's a gap to be filled here, a gap to be filled there. So there's reasonings why it could turn back up. Keep an eye on it. Next one is Apple. Now, Apple, again, is in a big traffic jam here. I'm expecting big things out of here. Why? Because all my averages have closed in at 260 bucks, which means the market's not going to stay at 260 bucks that much longer. Because you can see when they come together like they did here, it tends to be a precursor to a pretty good sized volatile move sometimes, right? So what do these guys got cooking that might be interesting? How about on March 4th when they come out with their new products? What new products? Well, suppose this is all rumor or fact. So in other words, nothing's etched in concrete, but they're talking about an i17 situation where it's a much thinner model. Thinner model might attract some activity. Also, they have a relationship with Gemini and Google now. So they're going to take that Siri that everybody complains about because their answers aren't very good. And it's going to really put that into a different level because of the Gemini AI software. So there's some exciting things coming up with Apple in addition to iPods and other wearables, etc. So that March 4th meeting could be very interesting. And sometimes this thing can get bid up very aggressively going into something like that. So keep an eye on it. I think there's potential here. Again, there's also potential to go down to 235 bucks. So if it can't get through 260, or if it doesn't hold 260, and you start seeing it take out 255, get prepared for a more significant drop. And this is the kind of number that it could go to give you an idea. Okay, so that's two of them right there. Let's take a look at, and we already went over Microsoft. We said there could be value there because of the double low down here and the divergence on the RSI. So keep an eye on it. How's that look like on a 5-day basis? Again, your RSI is down here at 38, so it's starting to hold 40. That's nice. Back above 40, so that's a good sign. It's holding the 40 number on the 30-minute graph. On the 1 hour graph, where were you down here? You're at 25 RSI. What are you down here? You're at 39. That's a divergence. So again, I'm getting hints that it might go back up. So keep an eye on Microsoft. There's three of them there: Amazon, Microsoft, and Apple. How about the Google? Google has it all working as far as this stuff is concerned. They're the ones that are making money. So it's had its correction down. Does it look like it might be on its way up? To me, it does. Again, it's got problems, just like the S&P. S&P's got a lot of problems around 6,900, 6,950. If it breaks through there and we go to 7,000, I say we break through 325 and we're probably going up to test the highs. And again, it's had its correction down to a couple of support zones. So it's possible this is the pullback that it was going to have down to underneath 300 or so, right? What was the low there? 296. So they broke it under 300 and now they're at 314. So there's a reason why it may stop and go back up. And the reason is like I say, it came back down here. But the one that it really hit was my weekly graph right around here, where the low was supposed to be 294 and the low is 296. That's pretty close, isn't it? Okay, so what else do you got here in the magnificent Tesla? Okay, in Tesla, pullback has occurred, right? It has occurred. So that would be the number that you'd want it to hold. What number is that? That number is the low of 414. Oh, not 414. Of, where's my cursor? There's my cursor. 387. That's your line in the sand, right? It also corresponds with this low here. Okay, so you want, and the RSI is right at 49. So you want this thing to not go underneath there. If it does, you could have a pretty good drop. And this stock can do anything it wants to do because sometimes people believe this guy's got all the answers as far as robotics and going to Mars, and now he's not going to Mars, he's going to the moon. And then sometimes they realize his car sales really stink. And then they start going to the moon with him again. And now they pulled back because there's questioning. Obviously, I think there might have been some accidents with the robo cars. I'm not sure. That probably would be something to bring it down. So this thing is either going to hold and get back on the bicycle, which is what the trend is telling me it's going to do, or if it does collapse underneath these numbers, there's plenty of real estate down here. So keep an eye on Tesla. That 390 area ballpark, that should hold. And again, right now the blue line is even higher, coming in at 397. So we really don't want it underneath 395 at this point. Okay. And it does look like it has some kind of a future to go back up. Again, just like the S&P, though, there's clouds above. So if we break 7,000 on the S&P, if the VIX gets under 17, 18 and starts going down, and if that percentage of stocks can get going above 62, 65, this thing will break above here, I'd imagine, and we'd go on a nice rally, maybe to fill that gap at 480. So keep an eye on it. And the last one I'm going to go over here is Meta, M-E-T-A. And again, Meta looks like it had a nice 1, 2, 3 formation a little bit. Let's go to the 20-year graph, start out way wide, and you can see it's been holding this green line very nicely. First low there was at 581. Then the next low there was at 600. So again, it has been holding that neighborhood. If it breaks that neighborhood, you can see there's more downside towards here. Let's look at it on a 5-year basis. Again, it has a nice higher low, higher low. So again, there is some support in this 575 neighborhood. And then on the 1 year, similar to everything else, it's got resistance between 660 and 680. If you get above there, it opens up the whole area up here. So again, you still got a gap that it could come down into. So, but the RSI looks like it's turning up. So this could be a 1, 2, and then a 3 formation to get going. It filled the gap, so that's all done. So again, if we get good vibes out of Nvidia and they change the mood, the sentiment, the positioning, there's some good potential in not only the software, but also the Mag 7. So keep an eye on that because that could be where some of the value is. And again, if they do change their tune, some of the area they might get the money out of is this area. This is called the staples, and this is where your PE ratios are huge, enormous. And the other ones I mentioned are where they've been compressed. So again, I think they said it's been decades since the PE ratio on software and tech stocks were under staples because of the growth rates. There's only so much Coke is going to grow. There's only so much what, you know, Procter and Gamble's going to grow or Walmart, you know. So that's why that's normally a lesser PE ratio. But that's not what's happening now, which is odd. And odd sometimes doesn't last. So that's why I'm having this meeting today to try to, front run the possibilities. So to review again what I talked about here, I talked about obviously the Supreme Court decision, which we're going to see more about the fallout next week and or no fallout. And then basically we went over the PCE and the GDP. So the inflation numbers are elevated. 3% core is elevated. It's nowhere near the 2%, right? So an issue. Spending is good. Okay, and that's a good sign. And wages are not bad. I think they're still up 3% or 4%. So that's not bad either. And then, of course, we went into the big earnings coming up on Nvidia, which is coming up on Wednesday. And again, how that could be the catalyst if we hold those levels on the S&P. And let me just put that up there again so you can see them. Again, you certainly do not want that 60 on the S&P. This is SPX. If you're looking at the E-mini future, the number is 6850, I think, whatever the low was here. 68.47 and the average comes in at 68.52. So that's obviously an important number. If you take out 68.50 and then you get under 68 on the future, it opens up a rather significant potential drop. So that's why it's very important that we get going the other way, which we're obviously trying to do here on Friday as I do this report. And again, don't forget your VIX. Your VIX is still elevated, okay? And again, if you look at the 20-year graph on the VIX, I don't like all the moving averages under the price. You see all the moving averages on the VIX, 16. That's why I wanted underneath 17, 16 to feel comfortable. Okay, I'm not comfortable when it's trading above the moving averages because that means the path of least resistance is to spike up, and that's not good. What about on the 5-year? This is a weekly. Where's all the moving averages? They're under the price right now, and I don't like that. So you see that 17 number keeps popping up. That's why getting under 17 and getting above 7,000 on the S&P is very important to get this thing moving. And then, of course, on the 1 year, all the averages are still in that area I talked about. On the 1 month, it came down to support. You see, if it's holding support, that means it's got the possibility of going back up, and up is not good on the VIX. That's not what we want if we want to see a pullback. If you want to get the puts and get those going, obviously you want to see this VIX take off like you know what. And if the VIX goes to 22 or 23 and Nvidia disappoints on Wednesday, those 180 puts that I mentioned that expire on March the 6th, going for $400, if Nvidia totally gives it up and goes down to 160, obviously would be the best play on the board, or not the best play on the board, but would be a play. So again, keep that in mind as well. Before I sign off, I just wanted to explain how you guys could get started with me. And like I say, I've been doing this for a long time, so I know many of you guys have been um, with other services. And some of them you didn't like, and some of them you liked, and then some of them, you couldn't figure out, or you didn't have enough time, or whatever. And so basically, I understand all that. But I do understand that I have value here for you, and I have value at a very, very low price. And that's not a bad combination. So let me explain basically what we do here. I specialize in trying to find options that are low priced, that have the potential of going and exploding. So when we're wrong on an idea, the premium is your maximum risk, and your premium is generally in the $200 range, which is pretty reasonable maximum risk on anything. But they have a lot of potential if you get moved because of the leverage factor. So, to give you an idea, every Sunday night we come out with an alert. Now, here's 20 ideas that were on the alerts that expired last month, January, to give you an idea of some of the ideas. Now, these are the best ideas. Not every single one of them explodes. That's why you have to use risk management. That's why you have to not over leverage your account. And you have to be careful on your, how much you put on and how you manage them. Because again, not every single one is going to work. So on everyone comes out on a Sunday night. So on Sunday night, November 23, we had an idea on Abercrombie and Fitch. ANF is the symbol. The idea expired on January 16th. So that was the expiration date. The call option was 80 because the stock was trading under 80. And obviously, we thought it would go up. And then we had a 50 put for insurance. Now, you don't have to buy both of them at the same time. If you think the stock is definitely going up, the first thing you do is buy the call, and then you can buy the put at another date if you need it. But if you do buy them together, the total price was 275. Now, did we get a move in Abercrombie? You go look at the chart. Of course we did. It went up to 133. And 133 minus 80 means the intrinsic value of the 80 call was 5,300 bucks because it's $53 difference between 133 and 80. And so that's 5,300 bucks because every option is 100 shares. That's a pretty big jump in equity as far as the value of the intrinsic value. Dollar General, we did 2 times, the 16th and the 30th. If something looks good, it's not illegal to do them 2 weeks in a row, right? So 120, 125s for 213 bucks, 261, and we got to move to 155. 155 minus 120 is 3,500 bucks in the money. 155 minus 125 is 3 grand in the money. We had an Alibaba on December 7th that expired today. But before it expired today, as you look at the chart, it went to 173. And so that is 3,800 bucks in the money. So as you notice, the amount we're taking a risk on per strangle or per options here is in the $200 range. And if they move like these did, there's obviously a lot of potential. If they don't and you don't get out of them, your maximum risk is what you put up. Now, last year, we had a lot of other ideas. Teradyne. And by the way, it's called an alert. So I'm going to be alerting you that I think this stock is worth your attention. Do you think Teradyne at 125 in September was worth your attention? How about Applied Material at 210? Google at 230? Rigetti at 19? Thing went to like 50 or something like that or more. Google 225, 225. Bring it to your attention there. Okay. Seagate at 125. What's it trading at now? Boeing's way above 200. DigitalOcean went to like 60, 70, and here's at 37 back in August. So, you're being notified of stocks that I think you should take a look at. Look at IREN at $8 a share back in June. So we had a lot of ideas last year that had merit. And some of them, we talk about longer term options. Look here, in August and September, what was I telling people about? Micron at 20 and 135. The thing, you know where it went. So here's what I'm asking you to do. Give us a shot. You click on this link here, and you've got two choices. One is You can go quarterly or yearly. Both of them are being discounted $100. So you see the quarterly, if you tap on it, it says 397. Down here, it's 297. What I suggest people do is do the annual. It's a much better deal price-wise. Not 997. You get a whole year's worth of information for only 897. Either one you choose is whatever you just choose. But this one I think is better because it comes with three things. Both of these things come with three things. As soon as you hit complete purchase, you get your receipt and you get a course. The course is called the Options Masterclass, and it's in three sections: beginner, intermediate, and advanced. It's worth $395 if you do it individually. So if you just wanted the course, it costs $395. When you buy one of these items here, you get it for absolutely free. So that's the first thing that happens immediately once you hit complete purchase. You get your receipt and you get your course. The second thing that happens is every Sunday night, you get my new reviews of the market and you get ideas. The third thing is the kicker. You're going to get my cell number. So if you have a question on something, strike price, expiration date, how does this work? How does that work? Any question you have, I can view my opinion and I can give you my view on it. I don't give advice. I don't give any advice, but I am allowed to explain things and I'm allowed to share my opinion. And that's what I do. So you get a course, you get ideas and a review, and you get coaching. That's a darn good deal for $897 for an entire year. That is a pretty darn good deal. So again, I know you've tried things other places. You might be having people you're working with now. The stuff that I do doesn't have to disrupt anything. The option prices are in the $200 range. You can do both. And it might not be a bad idea to get a second opinion because some people send me the stuff they get from other sources and we review them together. So I think it's a good situation for you. I'm coming to the top of my time. If you have any questions, email me at optionprofessor@gmail.com. OPTION professor@gmail.com, and I'll be responding to you no problem. So again, a course, ideas, review of the markets, and coaching with my cell number. And I think that's plenty. So do try to take advantage of it. I'm Jim, the Option Professor. I'm here available to you if you need anything. And I certainly hope you sign up and I welcome you on board. I'm signing off now. Have a great day. And thank you for watching this. And next week's going to be a very exciting week with Nvidia's earnings on Wednesday. Let's see if we can take advantage of it. Have a great weekend, everybody.